be running this last leg and be your ending keynote speaker today, talking specifically about innovation in the channel. So let's dive right in because it's never a dull moment right now in the automotive space. I'm going to try to convince you in the next 30 minutes that we are going to see more change in the next 5 to 10 years than we've seen in the last 100. If you're following the news cycle, which you can hardly not do nowadays, probably not a lot of convincing needed, but let's frame that up and look at some of the more interesting trends that are going to be able to be forecasted out for the next 5 to 10 years. So if we look at pre-COVID numbers, there was a lot of fear in the industry about profit margin compression. And we've had some alleviation of that the last couple of years, thanks to COVID, and really artificially suppressing supply of both new and used vehicles while demand has stayed strong. But I firmly believe that we'll get back to what will look like an environment pre-COVID, and dealers will be sitting with a situation where there'll be pressures coming on the front end of the vehicle purchase and the back end of the vehicle purchase. And I think that we'll discuss some opportunities today to alleviate some of that pressure. Talking to dealers frequently, quite a few don't know when these pressures may mount again, but generally recognize that the sort of artificial high profit environment that we're in right now due to COVID and new vehicle inventory shortages won't persist forever. It's a shame. Many of the automakers do talk about trying to match supply and demand going forward and ensuring that vehicles sell at or above MSRP. But for a multitude of reasons, I think that we will probably get back to more of a regular environment afterwards. I'm going to present a few slides today, but any audience members that are interested in asking me questions real time, I will monitor the chat. So please fire away, and I will try to weave them into the conversation today. If any thoughts get provoked, don't hold back, and please don't feel shy about asking questions. So, dealers are facing a new environment, right? It's a new frontier here where there's a lot of change going on, some of which we'll explore today. But dealers have to be sort of leaning in and embracing the fact that we're going to be operating in entirely new environments, and whether it's looking at ways to optimize revenue in new departments, or conversely looking at ways to continue to run efficiently with fewer employees and give those employees the tools that they need, and find ways to access consumers in ways that they want to be accessed, specifically as the migration to digital channels continues to follow the industry trends. As we look at the changes, and I encapsulate these in my recent book that I published, but there are a number of changes coming to the industry, not the least of which are things like electrification, direct selling, and a shift more, at least internationally, away from a franchise model to an agency model. But we've also got other things going on. We've got, vehicle connectivity continues to increase in terms of penetration, which will allow for things like over-the-air updates, will allow for subscription services that we're hearing more of, et cetera. The vehicles themselves are becoming much more reliable, but conversely, they're becoming a lot more complex. So when there are repairs on these vehicles, there no longer is a simple repair on a vehicle. They're effectively computers on wheels, and we'll talk a little bit about that today. And then finally, in the lower right-hand corner, there's dealership consolidation. So a lot of this up until recently has been really fueled by the public groups, some of which who have very robust plans around commercial segments. And but now that stock prices have come down to earth somewhat on the publics, I anticipate over the next 12 months, they're going to slow down quite a bit. When share price, a good rule of thumb for the public groups is when share prices are low, they tend to focus more on share buybacks. Wall Street really appreciates that. When share prices are high, they use that public currency to go buy stores. So I think we're going to have seen a shift here starting to materialize, moving from more as consolidators to focusing on stock buybacks. But that'll all be predicated on what valuations are in the stock market. But with this environment about more uncertainty coupled with higher interest rates and the fear of the R word, that we may or may not, be in a recession, and that will persist. I think we're going to find many of the publics may start to slow down their pace of consolidation, which has been very rampant recently. So I always like to preface things and put things into context in terms of what the manufacturers are doing overseas. And a good case study to keep an eye on is in Europe, where there aren't state franchise laws to protect dealers. We saw in June of this year, Stellantis, the parent of brands such as Fiat, Chrysler, Dodge, Jeep, Ram, terminate the franchise agreements with 15,000 of their dealers across Europe. And they're replacing those franchise agreements with an agent reseller agreement. The main change being that the dealers will no longer be responsible for holding inventory and taking the inventory risk. And the dealers will no longer be responsible for marketing to the consumer. In this case, Stellantis has said, we want the dealers to still exist to be the point of delivery, but in terms of inventory risk and advertising risk, we're going to look after that. And we still want you to service the vehicles after the vehicles are delivered. But they're changing the economics of and the definition of the dealer and their role pretty dramatically. And as I like to remind dealers, these are the same manufacturers making these decisions in the same boardrooms for various countries across the world. So we need to pay attention to what is being orchestrated in other countries, because there will be implications, as we're about to talk about here, back in the US. Mercedes and other brands are doing the same thing, talking very overtly about shrinking their footprint. So more concentration in larger urban areas, more volumes being pushed through those stores, and at the same time migrating from more of a franchise model overseas to an agency model. And then the other thing is just talking about these changes, it's worth keeping an eye on right to repair acts, right? Because as the cars do get more complex and are harder to work on because of technician skill needed, tools needed, and there's going to be more folks trying to get access to the vehicle data. And there will be advocates to make sure that the independent repair shops can continue to get access, and the aftermarket who are looking to install aftermarket products into these vehicles. But the OEMs, the automakers, will be building a very complex vehicle with very complex software. It's not going to be as easy as it used to be to bolt on aftermarket products. So we're going to see this play out, I think, in the courts in terms of where we end up, probably state by state, around right to repair acts. But at the same time, it'll just be very onerous for anyone who's trying to work on these vehicles who doesn't have the access that an OEM or a franchise dealer has, because the cars are going to be so complex and so heavily weighted towards software. So what else is going on? We aren't going to a pure agency model in the US, but many of the manufacturers, as they launch new EV models, are redefining the relationship with their franchise dealers. So I wouldn't be as bold as to say that the franchise agreements are getting rewritten, but they're getting redefined. So what we've seen recently, what you're looking at here is a bunch of information, but let me break it down for you. So Ford dealers by the end of this month, which now we only have 4 more days, have to elect for a 2-year period into one of 3 buckets for passenger vehicles, not commercial. We'll get to commercial in a minute. So if I'm one of the 3,100 Ford dealerships that sell passenger vehicles in the US, within 4 days, I have to self-elect into one of 3 buckets. Either I'm going to only sell ICE vehicles, and remember, Ford has launched a couple of hot vehicles recently, the Mach-E, which just won Car and Driver's Car of the Year, as well as the F-150 Lightning, and they've got a whole bunch of new E vehicles coming out. So dealers will say, for the next 2 years, I'm only going to sell ICE vehicles, meaning that if a consumer comes in and asks for an EV, I effectively have to tell them, no, I don't sell EVs. You have to go to a different Ford store. The middle bucket there at the top is kind of straddling, ICE and EV. These are dealers that say, hey, for about a $500,000 commitment, I am committing to being able to sell at maximum 25 EVs a year. So it's a big commitment for a small number of vehicles. But at least in this case, a dealer doesn't have to turn down consumers that walk into their showroom asking for EVs. But in this case, they're not going to stock EVs in inventory, and they're not going to have demo vehicles. They can continue to sell ICE vehicles. On the far right side of the continuum is a dealer that says, I'm all in. I'm going to invest up to $1.2 million, most of which are fast chargers. And as a result of that commitment at that level, I'm going to get an unlimited number of EVs that I can sell. I'm going to be supplied with demo models of EVs. and I'll be able to continue to sell ICE vehicles. It's causing anxiety, and we have a number of Ford dealers that are in our venture fund as investors, and dealers have this lit fuse. They have to make a decision by the end of the month, and by the end of the month, and there's no real good choice here based on the financial commitment and the constraints. But dealers are having to elect their way into one of these three buckets. Down below, same manufacturer, Ford, in terms of the pro commercial vehicle program, they're going to have to elect into whether or not they want to be approved as a commercial vehicle center. And there will be, of all the Ford dealerships, approximately 600 dealers that elect into this or chosen to participate. While there will be other Ford dealers who are able to sell sort of a light version of commercial. There'll be 600 that are kind of authorized as commercial vehicle centers. And those commercial vehicle centers in the top 30 markets will also need to make additional investments in mobile service vans to be able to offer mobile services at a consumer's either driveway or place of work. So while we see up top what's going on the retail side of things with EVs, a very similar sort of like process, which can be anxiety ridden, is being played out for dealers across Ford in terms of the commercial program. And it's just interesting dynamics right now. So it isn't as easy as just saying, we're going to be grandfathered in to sell EVs or not. Dealers are proactively having to make these decisions, which are going to have big implications on what they're going to be able to sell and how they're going to be able to sell these vehicles. And I suspect what we'll find is Ford is only the first. There'll be many others. But luckily enough, we've got Work Truck Solutions that's able to step up and help dealers navigate through these decisions. And specifically on the commercial vehicle side, they're offering new technology to enable any Ford dealer, any dealer that is in general, but any Ford dealer in this case, to get into the commercial game, step up, and both sell and service commercial vehicles. So thanks to Work Truck Solutions for bridging the gap and enabling dealers who want to raise their hand and get into selling commercial vehicles to find that process slightly less daunting. McKinsey, talking about EVs, we'll stay in that vein for a few minutes. McKinsey's been the most aggressive consulting firm that I found in terms of what they're forecasting in the US in terms of likely penetration of new passenger vehicles in terms of EV. We'll get to commercial vehicle penetration in a second. But they're saying that by 2030, which is now only about 7 years away, they expect that about half of the light US passenger vehicles sold in the US will be EVs. Where we're tracking so far is far less than that, as you know. This is information from Wards recently that show even the last quarter of in the US, we were only tracking at about 6% of vehicles. Although, as you can see with the green line, it is going up pretty much in lockstep every month. So the percentage is increasing. What we don't know is how much of this is because there just aren't enough EVs available right now, and what the actual natural ceiling of demand is, which we'll start to be able to test soon, because we're about to see a whole new slew of EVs hitting the market, and we're going to be able to test what natural demand of EVs is. So far, we've had a supply-constrained environment while there's been a lot of buzz around EVs, and therefore this percentage is increasing at a quick rate, but still as a percentage of the entire vehicles sold every year, still a very low percentage. And why is that? Well, we're seeing still, I kind of think of this triangle of range anxiety, of access to charging points, and then the speed of charging. Cost aside, and battery constituents have gone up quite a bit recently, therefore keeping EVs at a premium to their ICE vehicle counterparts. We still have, for various use cases, whether it's commercial or passenger, this vehicle range, access to charging, and charging speed, which until we start to vanquish those items, we're still going to have a lot of resistance potentially against purchasing vehicles and putting them into fleet, be it either for passenger vehicles or for commercial. IHS's numbers show, this is an interesting chart. So what this shows, these lines from the bottom, we can see on the far right, the black line was a forecast of EV penetration all the way back to April 2016, and what EV penetration was forecasted to be as a percentage of production forecasts in the US. And you can see every year, as we look up that line, the lines got more aggressive, and we suspect they'll continue to get more aggressive, where, if you extrapolate them all out to 2030, you saw that we've continued to increase the forecast in terms of a percentage out to 2030. And most recently, IHS is forecasting out to 38% of vehicles, a little less aggressive than McKinsey, by 2030. Up top, we're looking at commercial EV production being less than passenger. And that isn't too surprising, as we'll talk about here in a second. But with commercial vehicles, the constraints are a little bit more, because unless you're on a fixed route in a dense urban area where you're coming back to a supply depot or somewhere where you can predictably charge the vehicles every night, and weight isn't an issue, then there are restrictions. There's a reason why the EVs that are selling into commercial right now are for use cases like school buses and garbage collection and fixed routes like this, last mile delivery, and not long haul. Long haul we haven't figured out yet, because where are the vehicles going to get charged, but also the weight starts to factor in and starts to constrain the cargo availability. So no time soon are we going to be seeing electrification on very long haul routes, but in urban areas for short haul routes where the vehicles return every evening to a depot and they aren't incurring too many miles, I think we're going to see a very quick migration towards EVs. And as you can imagine, I couldn't pull out the equivalent for commercial vehicles here, but it's the same concept. The actual drivetrain of an ICE vehicle is far more complex than an EV, and therefore that's going to have implications on a couple of things, including service intervals, which are going to be a lot longer. So this is Jose Munoz, who said that the rule of thumb is that electric vehicles are going to require about 1/3 of the service needs of the equivalent combustion engine. And then also from a parts complexity standpoint, this is McKinsey forecasting that over the life of a plug-in EV, battery EV versus an ICE vehicle, it's going to consume about 40% fewer parts. So this means, the service intervals are going to be longer, the parts consumption are going to be less. There are implications for dealers, but also for the manufacturers themselves that typically have very profitable parts businesses where they wholesale parts. So let's shift gears and get into connectivity, which is probably the most exciting, to my mind, area of the business. So if we look back in October last year, almost exactly a year ago, GM CEO Mary Barra stood up at an investor conference and said, look, you should start thinking about the car more as a device, right? We're going to sell the hardware, but then we're going to build out in parallel a software platform where we're going to be able to do a lot to service and sell consumer services on top of that software platform. And she said at the time that currently we make, about being GM, $2 billion a year from subscription services to cars. That's all OnStar. But we're going to grow that $2 billion by 2030 to about $25 billion. The biggest lever we have is a usage-based insurance, based on consumers being willing to have their driving habits monitored and potentially be rewarded with lower insurance rates. But there's all kinds of other high margin subscription products that are going to be built and sold to these vehicles. So Stellantis followed suit and said over $20 billion in revenue from high margin subscription services to vehicles. And Ford said the same, both on the commercial side and the retail side. So what we're going to see is start to see options unbundled and sold separately, potentially on a monthly subscription basis. And we'll talk more about that in a minute. But let's get back to over-the-air updates for a minute, because if you're able to push updates, that has a big impact for potentially on warranty work. And this is one consulting firm who a few years ago said, of the approximately $18 billion in warranty work done per year in the US, with over-the-air updates, we're going to be able to avoid approximately $6 billion of that work, i.e. software updates to the computer that is going to not necessitate the vehicle being brought into the dealer for that work. Well, this is work that right now goes into a dealership and gets reimbursed by the manufacturer and is good, profitable work for the dealer that will be foregone now because of over-the-air updates. Another consulting firm looking at, in aggregate, all of the money that the manufacturers will save through over-the-air updates. These are billions of dollars, you see, these vertical lines. But the forecast by IHS is that by 2025, 3 years from now, the OEMs in aggregate will save approximately $60 billion, $60 billion in cost avoidance through over-the-air updates, largely through not having to recall cars and avoiding, like I showed in the previous slide, the warranty work. This is all cost today, so all of that will flow through to the bottom lines of the OEMs as additional profit. So they're seeing this as a boon going forward. So let me now shift gears again and talk about autonomy. So autonomy 5 years ago, the consultant firms would generally said that by now, half the cars sold would be fully autonomous. Uber and Lyft would switch their business models to robo-taxis. And for a lot of the miles driven, we would be sitting in a vehicle that had no driver. Well, clearly there have been headwinds. And getting to level 5 autonomy now may never happen. But where we sit is the more interesting use cases actually apply to commercial before passenger vehicles. So what we've seen is a lot of innovation in mining, in agriculture, in construction, where if you've got fixed routes and there aren't humans running around the streets or riding bicycles, you can move much more aggressively towards autonomy. And so I think we're going to continue to see a lot of innovation over the next few years in commercial applications, not so much in passenger vehicles, despite the fact that ADAS systems, protective ADAS systems in vehicles are becoming very sophisticated as a result. And then one of the smartest VCs in the space, Riley Brennan, said, makes the argument, which I believe strongly, that computers are going to be smart enough to know that they shouldn't be operating in thunderstorms, they shouldn't be operating on slippery roads, they shouldn't be operating in ice storms, and probably hand back the controls to the human. So if the human wants to take the risk in those kinds of environments, great, but it's almost an argument against us ever getting to level 5 autonomy, i.e. full autonomy in every inclement weather condition. But as I said, conversely, there's a lot of hope now for commercial. So we're seeing innovation with driverless cargo moving within shipyards, for example. One of the ones that I think and I'm most hopeful about is convoys of vehicles on the road where you'll have a human driver, in the first cab, but every other vehicle behind that first cab will not have drivers. And you can kind of think of it as a trailer train, right, with cars. And if any one of those cars ever has an issue, like a blown out tire or whatever, the entire convoy will be able to pull off to the side of the road. They'll be able to decouple the one unit that has issues, recouple, and then get back on the road. And we're going to go, because of technology like this, I firmly believe that we'll go from a long-haul driver shortage to a surplus pretty quickly. And you may even see in the future dedicated routes for convoys such as this. I'm not arguing that every one of these vehicles will be autonomous, but every vehicle except for the first vehicle that will effectively be in control, kind of like the conductor in a train today, where you've got a human in the front and then there's nobody in the rest of the vehicles. And then interestingly, whether it's drones delivering light packages or innovators like this company, Neuro, they were the ones that developed the rather gimmicky Domino's pizza delivery truck that would cook the pizza while it's on its way to your house. They're experimenting with this on the West Coast. They've had some challenges recently with real estate on sidewalks, but I think that it's very interesting to think of a future where we won't need humans in the Amazon trucks delivering cargo to your house. You'll be able to go out, swipe a QR code on your phone, the appropriate door will open, you can retrieve your groceries or packages or whatever it might be. And like I said, that'll be a combination of aerial through drones and small devices, commercial devices that are running around to your home. Okay, so let's wrap. I've got about 5 minutes left. Let's talk about the future. So this is always a slide that I hesitate to show, but I kind of like the analogy. So I liken running a dealership to squeezing a water-filled balloon. And what I mean by that, if you squeeze, I should have a prop with me, but if you squeeze a water-filled balloon, if you've ever done that before, you poke on one side and there's a bulge somewhere else, and then you poke on that bulge and it bulges somewhere else. And the metaphor really resonates with me because of this. Dealers don't run just one profit and loss, right? A dealership runs up to 8 different P&Ls within one rooftop. So, and as the internet has brought transparency and shrunk new car front gross profits and used vehicle front gross profits, what have dealers done? Well, they've been very intuitive and ingenious with allocating more resources to finance products, to insurance products, to focusing more on service and part, to diversifying through commercial divisions, through selling accessories, through building collision shops. So this is, I believe, the secret sauce to why the dealership model has been and will be so resilient into the future, is the fact that you aren't running one business, you're running a multitude of businesses. And I believe that, if we fast forward 5 years, we will see new departments emerge within a dealership. For example, as we said, software subscription services that get sold post-sale, that will be a department within a dealership. And we'll see new innovations. If I know one thing about dealers now, having worked with dealers closely for 22 years, they are the consummate entrepreneurs in America, and they're very resilient, but largely because of this phenomenon, which is diversification and reallocation of resources opportunistically as threats emerge. So final slide here is then, what does that mean for commercial? So I believe then when you look at that, the OEMs will continue to focus on commercial. Why? Because they see this not only due to demand, but the vehicles have simpler configurations. And the OEMs then can expand into new customers who are focused on a dealer's unique market opportunity. From a maintenance standpoint, offering commercial maintenance offers better margins than retail because of less competition, long-term loyalty with the customers, and more consistent cycles of higher average transaction prices. And then finally, in terms of services offered, the OEMs can offer new significant opportunities for the whole small, medium business ecosystem that surrounds commercial. And we've seen this over the last 5 years, the pace of innovation around telematics and folks offering payments, for example, gas cards or transactions through the vehicle itself, fleet management services in general, fleet management companies, and then warranties. I think we'll continue to see a healthy ecosystem surrounding the commercial segment innovating. So with that, I'll do some blatant self-promotion. I do have the new book out. It's available on Amazon. If anyone wants to reach out to me today, then I will happily send them a copy of the book. And but you can pick it up and let me know what you think. And then finally, I will wrap, I think, at time here and pass it over to Catherine, who can wrap the show.
Joining us for the second day. In retrospect, all of my dreams have been met. Thank you, Steve. You're my favorite wrapper-upper because not only are you so wired into what's going on, but in my mind, you will always be a futurist. And to me, that's where we need to end, thinking about the future. I really appreciate it. And the rest of you, thanks for joining. And we're going to be, you're very smart because by registering, you put your name on a list to be receiving the notification when we have all of these great sessions on video. And if you didn't get a chance to see them all, this is your chance. We'll also do a little bit of curating so that you can understand what are the best offerings for your particular situation. And let's all agree that's what we're doing here. We're gathering a group of people that are all stakeholders in a really exciting ecosystem that powers 80% of our GDP, holding hands, trying to get a good picture of what's going to be happening and making sure that we become more efficient and more collaborative and everything more transparent. And I think that every day that we learn a little bit more together, it raises the boat level for everybody. So thank you all for joining.